Last Friday, the global gold market continued its year-end strong momentum. Spot gold strengthened again during the Asian session, reclaiming the $4,500 level intraday and hitting a new all-time high of $4,532 per ounce. Subsequently, it pulled back slightly due to profit-taking at high levels, eventually closing at $4,531.40 per ounce, up $54.53, or 1.22% from the previous trading day, extending the consecutive upward trend since last week. Meanwhile, the precious metals sector moved higher in tandem, with the main silver futures contract climbing to 78.9 for $7 per ounce, a 7.69% gain, further boosting the bullish market sentiment. On the fundamental front, multiple positive factors resonate to support gold prices at high levels. Geopolitically, tensions in Ukraine, local conflicts in the Middle East, and tensions in the South China Sea continue to escalate, coupled with the unrelenting U.S. blockade on Venezuelan oil tankers. Market concerns about the spillover of regional conflicts intensified, driving continuous inflows of safe haven funds into the gold market and strengthening gold's safe haven properties. A weaker U.S. dollar provided additional support for gold prices. On December 26th, the U.S. dollar index edged down 0.3%, touching a recent low intraday. The sustained weakness of the dollar reduced the cost of gold purchases for non-U.S. dollar holders, further expanding the elasticity of global gold demand and fueling gold's upward movement. Monetary policy expectations remain one of the core drivers of gold prices. The market generally anticipates that the Federal Reserve will cut interest rates in 2026, and there are reports that the U.S. president may nominate a new Fed chair with a dovish stance in early next year. This expectation has continuously strengthened the market's imagination of interest rate downside space, significantly enhancing gold's attractiveness in asset allocation. In addition, global economic uncertainty persists, and inflationary pressures in major developed countries have not yet been fully alleviated. As a traditional anti-inflation tool, gold has attracted institutional investors to adjust their asset allocation and increase their gold holdings to hedge potential risks, further consolidating the bullish foundation. The demand side also performed brightly, with year-end consumption and investment demand resonating. Major gold-consuming countries such as China and India entered the peak demand season. The year-end gold buying spree in China drove domestic gold prices to rise steadily, while India's wedding season brought substantial physical gold demand, providing solid downstream support for gold prices. Meanwhile, the inflow trend of gold ETFs remained unchanged, and continuous gold purchases by global central banks served as a medium to long-term support. These two factors jointly consolidated the bullish foundation of the gold market, making it difficult for gold prices to decline sharply. Important disclaimer: all the above content is for reference only and does not constitute any investment advice. Any trading operations conducted based on this information are at your own risk of profit or loss. Want to receive real-time interpretations of gold price trends and major market news as soon as possible? Subscribe, like, and share with your investment friends around you now. Thanks for watching.